Hello, everyone, and welcome to another episode of the Reinsurance podcast. I am your co-host, Jared Lee.
And I'm Ben Rose. Welcome, everybody, to another episode.
Welcome back.
Thank you. How are you doing?
Good. Today we're doing like a News Plus episode, which is an interesting sort of angle for us. So
Has that got a name? It's like a deep dive in consulting speak.
yeah.
What is it in a news context? Oh, no, it's not an exclusive.
Oh,
There's a thing, isn't there?
it is a thing. Yeah.
It's got some kind of name when you do a
It's like
I
a
mean, shout out,
journalistic
is.
report, like
when
a
you do a briefing.
like a segment, like it's like a 2020 segment, right? It's not just
There's a thing. Right?
it's
a feature.
a feature.
Anyway, we're doing one of those.
So, caveat: we're not journalists.
Yeah, big
Apparently.
caveat. Yeah. No. We are not.
But we've touched the last two news updates for those listeners who sort of follow us every month. You will have sort of seen us giving updates on sort of the Vesttoo sort of scandal saga, however we want to describe it. But some questions we're getting back from listeners is some confusion on what actually is the business, what are the terms being thrown out, and I think as an industry, and albeit we're guilty now as a podcast, for just being like, here's an acronym that you might not know. And I thought what we could do on this episode is unpack a little bit of the Vesttoo saga, but with the lens of what are the things that are happening? What was the business? What are the LOCs that are being potentially considered fraudulent? What do the various sort of developments around bankruptcy mean in practice? So make it a bit of an educational one for those who are following our news podcast, but with curiosity as they get bombarded with acronyms and things.
Indeed, and I think this should help. We're not going to be the breaking news source for as things develop with that story, but hopefully, as and when you do receive updates and you're reading through articles about that topic, you'll be able to read them a little more informed as to what some of the terms being thrown around actually mean and why they're important.
And understand the implications and impact that it might have across the business and across the industry. So if we then sort of start from the top and you look at Vesttoo as a business and what their value proposition was, you have this pool of alternative capital. We've talked about this in some early introductory episodes of Reinsurance, but you have sort of your traditional reinsurers, Munich Re, Swiss Re, rated carriers, rated paper, and then you have this pool of alternative capital, which is deployed to help fill other products out and provide capital to the space. Within that, then you have insurance-linked securities, which is sort of we've talked about again in podcasts before, but this idea that the sort of investment asset class is able to deploy itself against collateralized risk in many ways. Do you want to clarify that anymore? But
check out the dedicated episode if you want to go deeper on that one.
Yeah, and so historically, insurance-linked securities are very much focused on what are called short-tail classes of business, property being a super simple example of that. And the reason for that is because as those investors look for returns with sort of a lens on what that return period they're trying to get out of the investments are, at the end of the year, it's very clear whether the wind blew or or the earth shook, and was there a loss on those reinsurance programs or not. And then if yes, claims got paid, and if no, you got your premium, and that was the end of that. But it was harder to point it towards long-tail classes of business, things like casualty and accident, these types of things. And what Vesttoo's proposition was they could build out a pool of investors who wanted to deploy their capacity or collateral to reinsurance, but have that capital go towards long-tail classes. Cyber and accident and health and these types of classes. I won't go into all the underlying products they built out, but that's kind of the premise. And they built a really interesting way for them to do that, which then brings us to sort of the ways in which they might collateralize these types of risk.
Yeah, and I think the side you've presented there is very important. So the investor side. But one of the things that's become quite prominent over the course of this story is also the customer version, in terms of what it means for them to be able to access this other source of capital. Obviously, you could just buy reinsurance. It's the usual, traditional balance sheet reinsurers product, that contract that says if you have this many losses of this shape and size, we'll pay you this much in claims. But from a customer perspective, it can be really useful to have access to alternative sources of capital, often because it's cheaper, or it's able to provide you with coverage that's not available in a usual market. And also, I think on top of that, it sometimes is easier to get access to for companies that struggle to be selected for in the traditional markets. And this was really interesting, actually, reading some recent commentary from Andreessen Horowitz around their worry that a lot of the sort of full stack insurtechs who rely heavily on reinsurers to provide capital as their capacity, that this may be challenging for them now, given that there's this flight to quality happening where increasingly, the traditional reinsurers want to work with traditional insurers, the insurtechs and MGAs, etc., who want to grow quickly and get access to capital from somewhere else, potentially have less of an avenue through which to do this, given that Vesttoo was quickly becoming a prominent distribution model, effectively, for alternative capital that wasn't constrained only to short tail lines. So that, from a customer perspective, there's a bit of damage here as well, I think, to some of those propositions as well.
Yeah, and not deviating off the primary topic of this conversation too much, but that's also the reason the industry has always put such weight and importance behind things like AM Best and S&P ratings. It's this alignment to quality of capital. And if you have a triple B rating or lower, it's like you're just at the bottom of a panel and you're never going to get sort of first cut. So there is this focus on ensuring you have quality capital if you're able to prove yourself as being a quality sort of insurer in the market as well. So those things are all, you can beginning to see the connection between all of these components and elements of the industry.
Absolutely. So let's dive into just, I guess, what's actually happened here and some of the key pieces of the puzzle. So what the root of this saga, as it's being called, is that LOCs, letters of credit, were found to be fraudulent. So probably as a starting point, we should unpick what exactly
is
the
definition of
a letter of credit,
right,
and why is that involved? It's not one of the traditional terms that we hear when we talk about the cedent goes to the broker goes to the reinsurer, and they pay out the claims. Basically, this letter of credit exists far beyond reinsurance as well. It's a very general solution used by banks, usually in a commercial space, to reassure a transaction of some kind that it's actually going to happen between the two parties, and to give confidence to a side that's performing some kind of obligation for the other. So to give you a really generic example, let's say I agree to provide you with like 10 shipments of cheese, very nice French cheese. I might be concerned whether or not you're actually going to pay me once I've gone through the very expensive process of shipping all of this very expensive cheese to you. And so what I might ask to do, as part of my agreement to the transaction, is to say to the person, you, company X, I don't know what you're going to do with the cheese, you're a cheese restaurant, you want to buy this cheese from me, I might say, look, I need to be sure that you are going to pay me once I deliver the cheese. So can we arrange with the bank what's called a letter of credit, which guarantees the payment for us, so that in any case, the bank is there basically in case of default. So it's effectively an insurance product in itself, built into the banking system. Usually costs money, so normally some share of the size of the transaction or some fee in exchange for the bank basically guaranteeing your payment for my cheese, subject to conditions being met, which in this case would probably be my delivery of the cheese to you. There we are. Everyone's imagining this great big ship full of cheese. We're using our imaginations. Great work, listeners. Who knew this was a reinsurance podcast? So what's happened in this case is, presumably, obviously details are still coming out, is, Vesttoo has helped to arrange transactions between a a party, insurance companies, MGAs, etc., who were looking to get some reinsurance coverage from these third-party investors, and in order to sort of make sure that those insurance companies and MGAs who are buying coverage feel very reassured, they've said, they've asked for a letter of credit to prove that the funds are going to come through. The alternative here that we see in the world of ILS is normally that you collateralize those funds and you lock them away in some kind of special purpose vehicle or a protected cell company or something where it sits, lock and key and can't be touched until certain events have happened according to the contract. Yep. In this case, though, it sounds like rather than that, there were these letters of credit put in place that said, yeah, fear not,
it's still there.
It's going to pay out.
Yep.
Because even if these guys don't come off, the bank has guaranteed it. But what has emerged to be the case over the course of an investigation that keeps finding more and more instances of this, I think initially it looked like it was quite isolated to the present, but actually now seems to go all the way back to transactions as far as 2019.
Yep.
Some of those letters of credit seem to be fraudulent, i.e., not real, effectively, or written by somebody else.
Yeah.
in some
so
ways.
we'll pause there, because then what's happened is in July of this year, one of the clients, as you said, went and they need to make a claim. And they told the promise they take their letter of credit, they walk down to their bank. Well, I hope this is actually how it's happened. They can walk into the front door of the bank, right? But they go down to the bank with their letter of credit and they say, we need to make a claim and withdraw the funds for this letter, receive the funds from this letter of credit to pay for our claim. That bank reviews that letter of credit and goes, sorry about this, but this is not a valid letter of credit. To which that client went, well, that's confusing. How do you mean it's not a valid? There's always been this assumption that the letter of credit is valid. And there's processes and checks and balances along the way that the money is in fact being securitized or protected. And, it's if I'm waiting for my cheese and I got the letter of credit, I assume that this is all a trusted process. The banks are involved. There's all these sort of regulated entities involved there. So there's a number of checks and balances, and we might be able to talk about that in some depth later on. But there was a real surprise that the letter of credit that they then brought back to the bank to get that money wasn't valid. So that kicked off this process in July. As we began to dig deeper, and they sort of went, well, they've used letter of credits for multiple billions in collateral. Let's kind of start interrogating these. Is this a one-off, or are there more? And it turned out there was a lot more. The number I saw the other day was something in the realm of 2.3, 2.4 billion in overall aggregated letters of credit that potentially are included in this fraudulent process. And again, there's still uncertainty as to where that fraud originated, and it was initially with, as you'd expect, with one claim at one bank, isolated to that one claim in that one bank. It's now emerged to be a few different banks to be involved potentially, and obviously many, many more letters of credit individually. So it's beginning to sort of unpack what is the extent of this. And as you just said, it started in July with the first known, trying to claim and not being able to do so, seeing some evidence that the first couple of those fraudulent LOCs would have been back to early as 2019. So it's what's resulted then is every one of these cheese owners has these letter of credits, and they're all scrambling now going, there's a real chance that the person doesn't deliver and I don't have any means by which I can get this money. And everyone's trying to fill this and replace these products. That's the stage we're at now with many of these clients.
I think it's important to distinguish, and again, I'm not an expert on the specifics of the LOCs as they are typically arranged. I'm sure it varies quite a bit because they're quite bespoke arrangements, but what we're not talking about here is the fact that the investors that have got involved in supporting those clients with capital are fraudulent or not real, but rather the quality of their agreement is perhaps less than was initially thought, right? So,
and that's an important distinction.
Yeah,
when you look at these banks and stuff, it wasn't the bank
Well, exactly.
Yeah.
So let's say you've got a big pension fund, maybe, or something that said we're going to pay you in the event of this claim. I'm the product that this pension fund is competing with is, all right, put your money up front in this protected cell company, or similar, put it in this special purpose vehicle, so that it's the funds are there, we know they're there. Or you're competing with, you're a triple, a double A rated company that has this incredible record for paying claims and a reputation to hold on to, and so on and so forth. So the reason for having that letter of credit there was to basically give you a bit of a strong arm against something. If for whatever reason that pension fund goes bust and can't pay your claim anymore, or you end up in a queue of people waiting to be paid or something, and you for some reason your money's not coming through when it was agreed to be paid, or they refuse to pay it for some nebulous reason, you've got the guarantee that the bank will step forward and pay it in their place if you have a valid letter of credit, which in this case they don't. So it ends up being equivalent to collateralized, which is like having a A-rated, bit of capacity, to suddenly like, oh, who knows, the default risk on that agreement is suddenly huge.
Yeah.
Because you've got no backstop anymore.
Well, and then once that began to happen, the from the middle part of July to sort of the end part of August now, things escalated very, very quickly from that first claim, then through the process, which then resulted in a Chapter 11 bankruptcy filing in the U.S., as well as a similar bankruptcy filing in Israel, to try to sort of protect the assets that Vesttoo had as they begin to sort of incur the fees for legal battles and trying to sort out what the strategy is going to be. But I think it's another sort of part of this conversation that it's worth unpacking to the listeners. So Vesttoo had raised $80 million at $1 billion valuation, sort of the end of last year, end of 2022. But it doesn't mean that they've completely been liquidated as an organization just yet. There's more to unpack the nuance of what this means as well.
Yeah, and I think it was I didn't correct it at the beginning of the episode, and we remain to see whether it needs to be corrected or not. But when you said Vesttoo's business model was, rather than Vesttoo's business model is, again, we'll wait and see. I wouldn't want to comment on that. The point of the Chapter 11 bankruptcy is to give a company a window with which to kind of go into survival and replanning mode. It's known as like a reorganization bankruptcy. Or a restructuring bankruptcy. But basically, this provision has existed in the US forever. It's been used by tons of famous companies, like General Motors has used Chapter 11 bankruptcy in the past to restructure itself. There are a few guidelines around how it works, but effectively you go to the court and say, we owe a bunch of people a lot of money that we currently don't really have a good way to, potentially pay those liabilities. So what we want to do is to get this special protection whilst we sort it all out. And then during that window, we work with you, the court. So the court has special appointed persons who help the company, if they're successful in getting their bankruptcy under Chapter 11, to figure out, okay, this is the plan, this is what the new organization is going to look like going forwards, and this is how we're going to make good on those things, those liabilities that we've got. And I think some of the criteria is effectively it has to be in the best interest of the people you owe money to. For you to go through that process.
It opens up the door for like negotiation on those debts and these kinds of things as well. Like they probably will still, the intention is still to pay them at that point. It's not like you're abandoning them in the same, in like a Chapter 7 or similar. But it's we want to open this up. We might renegotiate some of them. We might navigate the others as normal, but we want to open this sort of vehicle up in which we can navigate this with a bit more time on our schedules.
And I think part of the reason for doing that, again, is, almost plugging the holes in a otherwise potentially not only leaking ship, but also ship being attacked by by neighbouring ships, right? Because we saw in particular that Aon's White Rock vehicle was heavily exposed and had some money moved out of its cells, as part of it, and they came in with a lawsuit along with the Bermuda Monetary Authority to try and get that back, right? And trying to handle that lawsuit in the middle of negotiations, and also attempts to I think, freeze some of those assets and put injunctions in and so on, would have made it very, very hard to continue doing that. So effectively, that Chapter 11 bankruptcy will give them a shield to try and figure out what they're going to do. They're going to have to deal with the requirements of Aon and the BMA and their legal rights at some point. But hopefully, this provision gives them room to figure out how to do that.
Yeah. So that's sort of where the story currently sits. And so there's obviously a lot of component parts and those incoming lawsuits, the Aon one's making the most noise. I don't think it's the only one. I think they're getting a few different lawsuits coming through, and certainly doesn't feel like that will come to an end anytime soon. But if we transition away from kind of things we know in the educational component of this podcast, and transition a little bit more into our speculative position around the impact this might have on the ILS market, and the impact this might have on reinsurance more broadly, or things that are happening. I mentioned a bit earlier the scrambling of clients who are using this to fill their programs elsewhere late in the year with potentially unfavorable terms. So that's going to hurt clients quite a lot. In one of the news roundups, the first time we talked about the importance of trust with these kind of things. What are your thoughts around the impact this might have for traditional reinsurance as well as these alternative capital vehicles in future?
Yeah, I think we've got to look at it from both the demand side and the supply side here. On the demand side, I think it will hurt demand as well as helping it, which sounds a bit confusing. I think people are going to be choosier and seek further reassurances from any providers of alternative capital that they use, possibly reverting more to longer tried and tested ILS if they go down the alternative capital route. I am wanting to see more evidence of the providence of those vehicles, etc. However, at the same time, as you mentioned, there are gaps to fill. Most likely, people who've suddenly got less good protection will want to top that up and make sure they've got the best protection so that they're satisfied. So we will see, presumably, effectively an elasticity of demand-driven increase in rates in some of those areas across the alternative capital spectrum, which brings us onto the supply side, where because we're seeing all of these rates increasing, we are seeing a comeback, quite a big comeback for alternative capital. I think we reported in the recent news that alternative capital is expected to go above 100 million for the first time in USD. That is, for a long time. If you go back to 2021, I think it was roughly like 500 mil of reinsurance capital, 100 mil alternative capital, but it wasn't quite at the 100 mil mark. So that will be a big milestone. And with Hurricane Idalia and other hurricanes potentially on the horizon, tons of wildfires, tons of everything else going on this year, it doesn't feel like rate momentum is going to stop. It might slow down a bit, who knows, depending on the season we have, but I think the conditions are really ripe for those interested to get exposed to alternative capital, to reinsurance and insurance related risk, to get involved, especially I think as now we reach a point where if you look at the sort of broader environment, you look at interest rates, etc., I think most people are expecting that the most recent rate rises by the Fed are going to be the last. To be seen. We'll find out, obviously, but most headline indicators, again, subject to any major shifts in general global supply of commodities, etc., that could push inflation up again unexpectedly. We would expect to see that. You have a lessening now. I think headline inflation had dropped way down to like 3% from 9%. So I think people are now thinking, okay, conditions are going to change soon. Now's the time to be exploring some of these more speculative classes.
Yeah, I think you'll see this work to the benefit of established alternative capital players and the vehicles that are owned by firms like Ren, by which they can source the pools of capital still looking and interested in this space. And I think it'll be a very high hurdle now for new firms looking to emerge in this space, right? We've talked about as the market hardens, you see introduction of new classes of reinsurers, and alternative capital being kind of one of those classes where new entrants can emerge. I think if you're a net new entrant, it's going to be difficult because the investors themselves are looking to find more tried and tested routes to put their capital. So I think that will be difficult there. And that flight to quality will be an interesting one where if you're in the market, you're Allianz, you're Zurich, you're AIG, you're going to have your pick of your reinsurers. But if you sort of go down the chain into those sort of startup MGAs and startup insurtechs, full stack insurtechs, but also to like small regional insurers who just don't have the spend that gives them priority, that flight to quality for the bigger, more established reinsurers might leave some of those smaller cedents in kind of a desert potentially, with like a greater need to source capital from places that aren't as validated, I guess. And so that will be an interesting one. You might see a bit of a shift there. So yeah, it's a weird adjustment between that supply and demand, where the demand is still going to continue to grow, and that's always going to increase the supply, but the flight to quality and those things will make it a really interesting dynamic of where that gets deployed.
And I guess this is maybe what sits at the heart of the discussion today is we had Vesttoo come in as a way of greasing the route, the distribution channels from or between parties to a reinsurance-esque transaction, but in doing so they've sort of become more victim to things like fraud. And that will hit hardest on those who are least able to distribute themselves. So one of the recent things that came out in the news, I think, was around Florida in particular as a market starting to become attractive again. After months and months of us reporting how horrendous things were in Florida, right? The rates have now got to a point where Berkshire Hathaway and others are sort of stepping up and like, well, I suppose we could help you out, given the price is now twice what it was, or whatever, right? So Florida's able to do that as a market because the scale is huge, right? If you imagine your 2x2, it's like, if you're a cedent, are you small or are you big? Are you unattractive or are you attractive? If you're big, even if you're unattractive, you're still going to be able to get some coverage because you just got such a big pile of premium to spend. But if you're small and unattractive, these new distribution models give you a real chance to go in with equally capital, which is arguably small or unattractive. Not necessarily small, but less established, right? Less, rather than small and big. Established and unestablished. We've found a way, I think, with Vesttoo to match relatively unestablished need with relatively unestablished capacity. That's going to go away a little bit, I think, as a result of this. And so it's going to be more of a focus, we say the flight to quality, but the flight to established cedents and established reinsurers.
The other thing that I think will happen as a part of that for those sort of new entrants is there's just going to be more hurdles. And the benefit you have and the strength you have as a technology company, as a startup, is just to be able to move fast. And being a capital provider in our space is already going to be have more regulatory burden and therefore be slower. But it's just going to add to that. You're going to now expect the sort of checkpoints you have to clear and cross to just take twice as long and to double and triple evidence all these things that you're doing. So that certainly isn't going to work in the favor of those companies trying to do that stuff.
Yeah, the classic move fast and break things switch to the move fast with stable infrastructure.
Yeah, exactly. But that was a deep dive. So we'll continue to cover the story, but hopefully that is a helpful sort of demystification, perhaps, of...
Strong word.
Yeah.
I like it.
I was picturing in my mind all these like letters that are implied in this.
You see you flooring away mist as you said it.
But hopefully that helps as you read the news and you continue to follow this story, what is happening, as well as some of our thoughts as to what that might mean down the road. So
yeah, thanks for listening, and we'll keep you posted as things develop further.
See you next time.